If we talk about the brand closest to everyday life in Thailand, well, OR has to be number one.
Absolutely.
It's not just a petrol station, is it? It's really this lifestyle business empire, and Cafe Amazon is definitely the spearhead.
Hmm.
So in a time of, really volatile energy prices, how much will OR's non-oil profits actually help offset that fluctuation in the oil marketing margin, especially looking at these Q3 2025 results?
That's the core question, really.
And what about that ambitious 5-year growth plan? What does it actually look like? Today, we are taking a deep dive into OR. Hello and welcome to Insight AI Brief Set, Thai.
Welcome. Yeah, OR is, as you said, probably one of the most visible companies, right? Sitting right there at the intersection of energy, infrastructure, and, well, everyday retail for consumers.
Definitely.
And our mission today is really laser focused. We want to move beyond just the headlines and answer that big strategic question. Has OR actually managed to structurally, decouple its profitability from the energy sector's ups and downs?
Because that volatility is, well, it's legendary, isn't it? For years, the market just saw OR as basically an oil company,
Pretty much, yeah.
meaning its margins were totally subject to global price shocks and, crucially, domestic policy here in Thailand.
Right. The oil fund interventions, for example.
Exactly. But then you have the stability and, frankly, the explosive growth of the non-oil side, led by Cafe Amazon. That seems to promise a different kind of future. So we need to know if these Q3 results prove that transition is really happening. Is it real?
Precisely. And to guide you, the listener, through this, we've laid out a pretty comprehensive plan for this deep dive.
Okay.
We're going to scrutinize the Q3 2025 results that just came out, really dissect the specific drivers behind those figures.
Get into the weeds a bit.
Yeah, exactly. Then we'll analyze the dynamics between, the historically volatile oil segment and that strategic growth engine, the lifestyle business.
Oil versus non-oil.
Correct. Before kind of zooming out to look at their ambitious long-term strategies, things like digital transformation, EV infrastructure investment, all that stuff.
Okay. And as always, we need to keep this analysis, timely and grounded. So where's the information coming from?
Good point. We're drawing exclusively from official company filings and the very latest market reports published right up to November 2025.
So super fresh.
Very fresh. This should ensure that you, the general investor, get a comprehensive and, importantly, objective look at the current state of play for OR.
Great. Where should we start? The numbers.
Let's jump straight into the numbers.
Yeah.
Because Q3 really delivered a major story of recovery.
Okay, let's unpack this then.
Yeah.
The core financial metrics for Q3 2025. We heard profitability roared back, which kind of sets the tone. What was that critical net profit figure, and just how significant was this turnaround?
Right. The key figure, the bottom line net profit for Q3 2025, it landed at 2,614 million baht.
2.6 billion.
Exactly. Now that number, 2.6 billion baht, it's impressive just on its own, but it's the context that really makes it stand out as maybe an indicator of a structural shift.
How so?
Well, quarter over quarter, so compared to Q2, it represents a solid 17.1% increase. That shows pretty strong momentum building from Q2 into the summer period.
Okay, 17% QOQ. But the really dramatic comparison is year on year, isn't it?
Oh, definitely. When you compare it to the previous year, the shift is, well, staggering. It really underscores how challenging that policy and pricing environment was just 12 months ago.
So what was the number last year?
Okay, so this 2.6 billion baht profit in Q3 2025, that's a massive swing compared to the same period last year, Q3 2024. Back then, OR actually reported a net loss of 1,608.75 million baht.
A loss of 1.6 billion. Wow.
Yeah, so that difference, you got a 4.2 billion baht swing from a significant loss to a pretty robust profit. It really signals a complete normalization of the market margin structure. We'll dig into that more in section 2. But essentially, it means those external pressures that just crushed margins last year, well, they were lifted this year.
Okay, makes sense. So moving from the bottom line, net profit, to operational health. How did EBITDA look? That's, before interest, tax, depreciation, amortization.
Operational health looked robust.
Yeah.
EBITDA for Q3 2025 reached 4,878 million baht.
Almost 5 billion.
Almost 5 billion. And this was an increase of 7.2% quarter over quarter.
Yeah.
Now, crucially, the sources are quite specific about where this improvement came from.
Okay.
It was primarily driven by the improved gross profit margin, the GPM, within the mobility segment.
Ah, so the oil business again.
Exactly.
Yeah.
This confirms that the engine of recovery wasn't some unexpected surge in non-oil growth, but really the stabilization of the oil business margins. It shows the cost structure of the business held up really well once those margins stabilized.
Interesting. So if we look beyond just the single quarter Q3 and examine the year-to-date performance, 9 months, right? 9M 2025. What does that tell us about the overall direction?
The 9-month figures really showcase a return to, let's say, historical profitability trends, especially after a very difficult 2024.
Okay.
Net profit for those 9 months hit 9,226 million baht.
Over 9 billion.
Right, representing almost 100% surge, technically 98.4% increase compared to the same period last year.
Wow, 98.4%. That's huge.
It is. And earnings per share, EPS, for the 9 months stands at 0.77 baht. So this near doubling of profitability year to date really tells investors that the company is, well, effectively recovering its normalized earnings power.
Okay, but hang on. That level of growth, 98.4%, it sounds phenomenal on paper. But if most of that growth is just recovering losses that happen because of, say, policy interference, is it genuinely structural? Or is it sustainable? Doesn't that massive growth figure actually expose how vulnerable OR still is to those external policy decisions?
That is the absolute critical question, you're right. And it speaks directly to why that non-oil segment needs to grow faster, When 98.4% of your year-on-year growth is basically fueled by stopping a previous loss factor, in this case, government pressure on oil margins, it's not really true organic growth in the same way. It's more like a return to normal.
A rebound.
Exactly, a rebound.
Yeah.
So the sustainability relies entirely on, one, maintaining that favorable margin structure, and two, simultaneously, whether the non-oil business can add significant growth on top of that stable base. Not just replacing oil revenue, but really accelerating past it.
Makes sense. So let's talk about this financial paradox that the sources mentioned. Profit boomed, but total revenue actually went down. How does that work? How do you explain that? It seems counterintuitive.
Yeah, it does seem odd at first glance, but it's actually a classic example of margin recovery offsetting a decline in volume or price, which is pretty common in commodity-linked businesses like oil.
Okay.
So total revenue from sales and services in Q3 2025 was 153,600 million baht. That was an 8.1% decrease quarter over quarter.
Okay, revenue down 8%. So OR sold less stuff, basically, and the stuff they sold was worth less in total baht terms, yet they made significantly more profit. We need to explain that mechanism clearly for, the average investor.
Absolutely. So the decrease in total revenue, it's attributed to two main factors. First, lower average global crude oil prices.
Right, oil was cheaper.
Exactly. And since OR basically passes that crude cost through, when crude drops, the final retail price tends to drop too, which reduces the total sales value they record.
Okay, factor one.
Factor two, there was also reduced sales volume, mainly in the mobility and global segments. This was partly due to seasonal factors like the rainy season slowing things down and also competition in the market.
Right.
However, the profit surged despite this lower revenue because the gross profit margin per liter widened significantly.
The margin.
Yes. That widening margin means OR kept a much larger percentage of the money earned on each liter they sold. This focus on margin optimization, supported by good cost control, is confirmed by the EBITDA margin. It stabilized at 2.1% in Q3. So they basically extracted maximum profit from a smaller revenue base.
That margin discipline sounds vital. Okay, let's switch gears slightly. Valuation. After such a dramatic earnings rebound, what does the market think of OR right now? Is it expensive? Cheap?
Well, the valuation metrics suggest the market is definitely catching up to this improved performance, but maybe not fully there yet. The market consensus forward price-to-earnings ratio, the forward PE, is noted at what looks like an attractive 13.1 times.
13.1 times. Is that considered attractive for this kind of company?
Generally, yes. For a business that's kind of integrating this high-growth lifestyle component, Cafe, Amazon, all that, with critical energy infrastructure. Analysts usually see a PE multiple in the low teens as pretty appealing, especially when you compare it to pure retail peers or pure energy peers.
Right.
It kind of suggests the market hasn't fully priced in the projected growth from non-oil just yet.
Okay. And thinking about their expansion plans, they're talking EV infrastructure, more F&B, new retail brands. Is that putting their balance sheet under strain? What about their debt levels, their leverage?
Doesn't look like it, according to the sources. The company's debt-to-equity ratio, the DE ratio, is stated at a very conservative 0.78 times.
0.78, so less debt than equity.
Exactly. To put that in simple terms, for every dollar of equity the company holds, it only has about 78 cents of debt. A DE ratio comfortably below 1 like that is generally seen as a sign of substantial financial health.
Okay.
And this ratio gives management significant headroom, flexibility to keep funding those ambitious expansion plans, whether it's new Cafe Amazon spots or new EV charging hubs, without immediate worries about debt burden or refinancing risk.
Right, so they have the financial firepower. Okay, that's a powerful financial snapshot then. Big profit recovery driven by margin strength, a seemingly favorable valuation multiple, and a really conservative balance sheet. This sets us up perfectly to dissect the engines underneath all this oil versus non-oil.
Right. So we've established that margin recovery was kind of the hero of Q3. Now we need to really understand the mechanics within those two main segments. Mobility, which is the oil business, and lifestyle, the non-oil part.
Let's start with mobility then. This is the segment that brings in the most revenue, but historically it's also the most volatile. We know the gross profit margin, the GPM per liter, improved significantly in Q3. What specific things contributed to that GPM strength?
Well, the GPM improvement was pretty broad-based, but it was strongest in the major fuel types, so think diesel and gasoline.
The big seller.
Exactly. And this margin resilience was the primary reason OR's profitability surged. It was actually strong enough to overcome that 7.7% quarter-over-quarter drop in sales volume.
Right, you mentioned volume was down. Why was volume down again?
That volume drop was mainly due to seasonal factors. The rainy season tends to reduce travel, and also just high market competition. There are a lot of players out there.
Sure.
But the key takeaway here is that profitability, for this quarter at least, became sort of decoupled from volume. Higher margins made up for fewer liters sold.
Okay. And the single biggest factor behind this recovery? It wasn't really something OR did internally, was it? It was more about government policy, specifically the stabilization of the oil fund. We need to clearly explain for the listener why the oil fund status gives such huge relief to OR's margins.
Yeah, this is really the central structural change that happened. The oil fund, or the fuel fund as it's sometimes called, it's basically Thailand's mechanism used to stabilize retail fuel prices for consumers, particularly for diesel, because that impacts transportation and logistics costs across the whole country.
Right. Keeps truck drivers happy, keeps inflation down, theoretically.
Theoretically, yes. So when global crude prices soar, the government often uses this fund to subsidize the retail price, capping it artificially low. But this intervention forces the oil marketers, including OR, to absorb the difference between the real cost and the capped price. It effectively caps, or sometimes even completely destroys, their marketing margin.
So the oil fund acts like a mandatory margin ceiling when prices are high.
Exactly. That's a good way to put it.
Yeah.
However, starting around May 18th, 2025, the fund's financial status stabilized. It actually moved into a positive position.
So it had money again.
It had money again, which meant the government no longer needed to maintain that really aggressive subsidy or that price cap pressure.
Okay.
So when that pressure was relieved, OR's marketing margins, particularly for products like diesel, were basically allowed to normalize back to healthier, more commercial levels. Analysts noted the margin for Q3 stabilized in a pretty strong range, around 0.90 to 1.00 baht per liter.
Which is much better than before.
Oh, much better. A level that would have been impossible to sustain when the fund was heavily in debt or actively subsidizing. So this policy normalization was just a massive structural tailwind for the whole mobility segment.
Right. It makes the Q3 results look almost like a policy dividend in a way. Now, looking ahead, Oris is also trying to be proactive, addressing the long-term energy transition within this mobility segment. They're focusing on cleaner fuels for big consumers like aviation and shipping. What are they doing in sustainable aviation fuel, or SF?
Yeah, this is really about looking ahead, about proactive regulatory compliance and positioning for the future.
Yeah.
Oris is forging some key partnerships for sustainable aviation fuel, SAF. Notably, they've partnered with Thai Lion Air.
Okay.
This is a direct strategic move to comply with incoming international regulations. For example, you've got the International Civil Aviation Organization, ICAO. Their rules are set to require airlines to start using a portion of SAF in their fuel blends starting as early as 2026.
So quite soon.
Very soon. So by building these supply chains now, Aura positions itself as a crucial supplier, ready to meet that mandatory demand from the airline industry in the coming years, and hopefully secure some high-volume, potentially premium margin contracts.
Makes sense to get ahead of the curve. And what about the maritime sector? Shipping uses huge quantities of bunker fuel, right?
They do. And OR is pioneering some lower carbon shipping solutions there too, partnering with shipping giants like RCL Regional Container Lines.
Okay.
Specifically, they collaborated to introduce and start using something called B24 VLSFO.
Okay, what's B24 VLSFO?
Right, so BLSFO stands for Very Low Sulfur Fuel Oil. That's important for environmental regulations already. And the B24 means it's blended with 24% biodiesel.
Ah, the bio component.
Exactly. So the key function here is environmental compliance and carbon reduction. By providing a high-quality, lower-carbon blend for these big cargo shipping vessels, they delivered it, for instance, to the PIYA BHUM vessel at Layam Shebang Port. OR is capturing a niche but definitely growing market. These shipping companies are highly motivated to decarbonize their supply chains. It shows OR is trying to future-proof its core fuel supply business.
Okay, so the oil segment got some breathing room thanks to policy stabilization, and it's looking long-term with cleaner fuels. But the real story of predictable, scalable growth that belongs to lifestyle, doesn't it? Let's shift focus to the non-oil engine.
Yeah, the lifestyle segment is really meant to be this stability anchor for OR. It generates consistent, high-margin, fairly predictable cash flow, and it's largely insulated from those global oil price swings. And its performance in Q3 2025 really demonstrated continued market dominance.
And Cafe Amazon just keeps expanding, relentlessly it seems. What was the specific record they set in Q3?
Cafe Amazon is, without doubt, the spearhead. In Q3 2025, the brand achieved a record sales volume, 109 million cups sold.
109 million cups in one quarter.
In one quarter. To put that in perspective, that's roughly 1.2 million cups sold every single day during the quarter. This represents a 2 million cup increase compared to Q2 and a very strong 11.2% growth year over year. What's quite remarkable is that this growth happened during Q3, which, as we said, is typically dampened by the rainy season. It suggests Amazon's appeal kind of transcends seasonality now.
That's impressive. And the physical footprint you need to move 109 million cups, that must be staggering. What does the total network look like now for F&B and convenience stores?
Yeah, the ecosystem scale is absolutely critical to OR's strategy. The total food and beverage network currently operates 4,729 branches.
Over 4,700.
Exactly. And of those, the vast majority, 4,613, are Cafe Amazon locations. That spans both domestic and international markets. This density, which they achieved largely through a really rapid structured franchise model they started back in 2002, has made Amazon the largest coffee chain in Southeast Asia, and actually one of the largest globally by number of outlets.
Incredible growth. And their convenience store presence is equally important, right? For cross-selling, keeping people inside that station ecosystem.
Absolutely. The convenience store network, which includes both their partnership with 7-Eleven in many locations and their own Jiffy brand, totals 2,347 branches.
Almost 2,400 convenience stores.
Yeah. And the Jiffy brand, which they acquired and developed, is really a key platform for them to incubate their own internal F&D brands, like Pearly Tea for bubble tea, and their food-to-go concepts. It gives them full control over the margin and the branding inside that petrol station environment.
Okay. But they can't really be a lifestyle business leader just relying on coffee and gas station snacks forever, can they? They seem to be actively pushing into new retail categories. What's the strategy behind this new health and beauty retail brand, Found and Found?
Right, Found and Found. This represents a very deliberate move to diversify that non-oil portfolio away from just food and beverage and into potentially higher margin specialized retail. It focuses on health, beauty, wellness products. Currently, it's got a modest footprint, only 12 branches, mostly strategically placed in high-traffic urban areas and maybe some premium PTT station environments.
Okay, 12 branches. But the outline mentioned an expansion goal for Found and Found. It said 50 branches by the year 2069. That sounds like a typo, doesn't it? Or maybe just some arbitrary, laughably distant long-term placeholder number. If OR is serious about diversifying beyond coffee, what are the realistic short to medium term goals that would actually show commitment?
Yeah, you're right to flag that 2069 date. It's almost certainly some kind of long horizon regulatory placeholder, maybe needed in the filing, rather than a real operational target. Doesn't make much practical sense.
No.
If we look at the context of their other aggressive brand rollouts like Pacamara Coffee Roasters, which they invested in, or Pearly Tea, which they launched quite quickly, the realistic expectation for Found and Found would probably be an immediate target of something like 5 to 10 net new stores per year for the next, say, 3 years.
That sounds more like it.
Yeah. The critical goal isn't hitting 50 branches by 2069. It's proving the profitability model and the scalability in diverse urban locations outside the PTT station network. Can their retail expertise work regardless of the fuel platform? That diversification is essential if they want to reduce their reliance on the cafe model eventually.
Okay, that makes a lot more sense. So mobility gave the Q3 profit spike, lifestyle provided the volume stability and record growth. But the global segment seems to have faced some headwinds. ###C, global business, and external risks.
Yeah, the global segment was definitely the laggard in Q3 2025. It's a good reminder for investors that external risks don't just stop at the border. This segment saw revenue and, importantly, EBITDA drop, mainly due to some highly localized geopolitical issues.
And the primary issue was centered in Cambodia, right? What exactly happened there? How did a border conflict translate into reduced revenue for OR?
Yes, the sources confirmed the revenue and EBITDA drop was linked pretty directly to a substantial 19.0% reduction in sales volume in the global segment overall, but heavily weighted by what happened in Cambodia.
19% volume drop is huge.
It is. And this was reportedly a direct consequence of a flare-up in tensions surrounding the Thailand-Cambodia border conflict. This tension seems to have triggered some nationalist sentiment among local consumers and, crucially, among local business partners, the franchisees.
Ah, the station owner.
Exactly. The impact was apparently severe enough that roughly 17% of the PTT-branded stations in Cambodia reportedly switched brands, starting around September 2025. So this wasn't really a commercial failure on OR's part, it was more of a non-market political risk that suddenly crystallized.
Wow, okay. That's a significant operational loss. How did OR manage to prevent this from completely destabilizing the entire global segment's performance?
Well, luckily they had some balancing factors in other key international markets. Growth in the Philippines, for example, was strong, specifically driven by OR winning several high-volume commercial fuel tenders there, which secured profitable business-to-business volume.
Okay, B2B helped.
Yeah. And additionally, performance also improved in Laos, where they apparently optimized their pricing structure and saw a higher GPM per liter, which helped offset some of the volume losses from Cambodia. So that geographic diversification within the global segment proved pretty vital.
Right, not putting all their eggs in one basket. And they also showed some strategic flexibility by deciding to exit a market that wasn't performing as hoped, correct?
Vietnam.
Yes, exactly. It demonstrates a clear focus on capital efficiency, which investors like to see. They made what seems like a pragmatic decision to dissolve the ORCG joint venture in Vietnam. Their subsidiary, SG Holdco, held 60% of that JV.
Why pull out of Vietnam? It's often seen as a growth market. It is. But Vietnam is also notorious for having an intensely aggressive retail market, especially for fuel and convenience. Margins there are apparently razor thin due to just fierce competition. So rather than continuing to pour capital into a really challenging fight for market share, OR chose to exit and presumably redeploy that capital into more promising, maybe higher margin international ventures, or even back into domestic growth initiatives here in Thailand.
Makes sense. Don't throw good money after bad.
Precisely. That kind of strategic adjustment is generally seen as a positive sign of management's discipline.
Okay. So putting it all together, OR's recovery and growth seem fundamentally dependent on, 1, policy normalization domestically for the oil side, and 2, the relentless, efficient rollout of the non-oil portfolio. This leads us straight into their long-term vision, right? Their strategy.
Exactly. OR's strategy is really explicitly designed to move beyond just being a transactional fuel retailer. The core goal seems to be creating this integrated, sticky customer ecosystem. They actually want to shift the average PTT station visit from just, say, a 10-minute transaction fill-up and go to more of a multi-purpose 30 to 45-minute retail experience.
30 to 45 minutes at a gas station, that's a big shift. How are they planning to achieve that? Seems like digital transformation is key.
Digital is absolutely the linchpin of this shift. The digital roadmap really starts with their centralized loyalty program, the upgraded Blue++ application, which they launched in Q3 2025.
Okay, an app upgrade.
But the real potential game changer here is the strategic cross-loyalty ecosystem partnership they established with AIS.
AIS, the telco giant. The sheer scale of their customer base is huge, isn't it? What does this partnership actually mean in practical terms for our customers or potential customers?
It's enormous. You're talking about integrating loyalty benefits for over 51.1 million AIS subscribers. That's mobile phone users, fiber internet customers, the works.
51 million people.
Yeah. These customers can now seamlessly use their accumulated AI suits for discounts and privileges right across OR's entire ecosystem.
Just say not just fuel.
Not just fuel, It covers over 7,000 OR locations. Fuel at PTT station, yes, but also drinks at Cafe Amazon, snacks and goods at Jiffy, potentially other things down the line. This move instantly gives OR access to this vast, highly active, and already digitally engaged loyalty base that they didn't previously control. It's essentially a massive customer acquisition shortcut designed to drive spending across all their different businesses.
That's clever. Leverage someone else's huge customer base. And the digital push goes further than just points, right? They're aiming for hyper-personalization inside the station with this intelligent station initiative. That sounds pretty futuristic. How will they actually achieve that kind of personalization?
Yeah, it does sound a bit sci-fi, but it leverages some pretty cutting-edge tech that's becoming more common. Or plans to roll out 200 of these intelligent stations in 2025. The core technology involves things like license plate recognition LPR cameras combined with AI-driven analytics.
So the camera reads your plate.
Exactly. When a registered member's vehicle pulls into the station, the system automatically identifies them. This integration then allows the station's digital signage, or maybe even the attendant's handheld device, to display highly personalized promotions almost instantly.
Like what?
Well, for example, offering you a specific customized coffee blend that you frequently buy from Amazon, or suggesting your preferred snack based on past Jiffy purchases, maybe the moment you step out of your car.
Okay, that immediate recognition could be powerful for boosting retail conversion, getting people to buy something extra. But let's circle back to that really ambitious behavioral goal. Extending the average customer stay time from 10 minutes to 30 or even 45 minutes. Is it really realistic to expect a customer who just stopped for gasoline to hang around for that long?
Look, it's highly aspirational, no doubt about it. It borders on a paradigm shift for what a gas station is. But it clearly illustrates management's commitment to transforming the business model.
How could it possibly work?
Well, to achieve 30 to 45 minutes, the station has to stop being merely a refueling point.
Right.
It needs to become more of a destination, would be a miniature community hub. This goal really relies on several factors clicking together. The quality and variety of the F&B offerings, like Cafe Amazon, maybe Pacamara, the retail diversity, like Found and Found, the efficiency and necessity of the EV charging process, because charging inherently requires dwell time.
Ah, the EV angle.
Exactly. And the appeal of those personalized promotions delivered via the intelligent station system. If they can convert even, say, 20% of their daily traffic into customers who stay for 30 minutes instead of 10, the financial impact on non-oil profits could be immense.
Okay, I see the logic, even if it's ambitious. So technology is the driver for that experience, but the physical infrastructure still underpins the whole strategy. What are the targets for expanding the traditional PTT station network? Why is that still crucial if they're focusing so much on digital and non-oil?
Maintaining and expanding the physical footprint is still absolutely critical, because every new PTT station acts as a platform, a physical anchor for the non-oil ecosystem.
Right, a place to put the cafes and shops.
Precisely. They're planning to open approximately 100 new PTT stations in 2025. This expansion targets a steady, maybe 3–5% growth in the core oil business revenue, just maintaining market dominance. But the real strategic value is that each new station potentially anchors 3 or 4 high-margin non-oil outlets, a new platform for Cafe Amazon, a Jiffy store, maybe eventually a Found and Found kiosk or something else.
Got it. And the energy transition demands parallel infrastructure investment too. How aggressively are they pursuing the EV market? You mentioned the dwell time.
Their response to the shift toward electrification looks pretty aggressive and, importantly, preemptive. They are rapidly expanding their EV Station Plus Z network. It's now operating over 1,300 charging points nationwide.
Over 1,300 chargers already.
Yeah. This massive network build-out is clearly aimed at securing OR's relevance as the go-to energy provider, regardless of whether that energy comes from a gasoline pump or an electrical plug. By achieving network density early, they hope to capture market share among the nascent but rapidly growing EV user base. And crucially, ensure those drivers also become captive customers for the non-oil retail offerings during that necessary charging period.
Right, turning charging time into shopping time. Finally, on the strategy front, we noted a corporate signal, maybe, of confidence in their own valuation. What was the indication regarding capital management?
Yes, the company recently indicated it is currently studying the feasibility of launching a share buyback program. Yeah. This is a pretty common move from management teams that believe their stock is undervalued by the market. especially considering that attractive, 13.1 times forward PE ratio we discussed earlier. A buyback basically signals management's positive sentiment about the company's prospects, and it's a commitment to using company capital to enhance shareholder returns by reducing the number of shares outstanding, which can boost EPS.
Okay, so an aggressive digital strategy, a healthy balance sheet to fund it, and maybe a helpful political tailwind in the oil segment for now. That seems like a lot of momentum heading towards the end of the year. Let's see how the market analysts are translating all this into investment recommendations.
Yeah, the strong Q3 results definitely solidified the market's optimism, particularly because the results confirmed that structural improvement in the critical mobility GPM, the oil margin. So the consensus among market analysts now seems broadly positive. They're generally anticipating continued strong performance rolling into Q4 2025.
Okay, positive sentiment. What are the main external drivers that analysts are pointing to supporting that optimism for Q4?
Analysts are highlighting two key things, sort of seasonal and structural tailwinds. First, there's the anticipation that those strong Q3 margins will largely carry forward, assuming, of course, that the oil fund status remains favorable and doesn't revert to subsidies.
Right, the big if.
The big if. Second, the arrival of the peak tourism season, the high season here in Thailand. That provides a natural boost to demand for both fuel, more driving, more tourism activity, and critically for non-oil products like coffee, food, and convenience store goods sold through that vast OR network.
High season boost makes sense. What specific factors are analysts emphasizing as the strongest arguments for investing in OR right now? What are they really liking?
The consensus seems to center on the elements of stability and growth. First, the sustained improvement and normalization of that oil marketing margin, especially for diesel, now that the government pressure has largely eased off. That's huge for baseline profit.
Okay, stable oil margins.
Second, the undeniable success and the scalability of Cafe Amazon. It just keeps posting record high sales volumes, driving predictable non-oil profit growth.
The coffee engine.
The coffee engine, exactly. And third, the demonstrated operational discipline. They showed efficient cost management in Q3, which allowed profit to surge even while revenue dipped slightly. That points to good management execution.
Okay, so policy relief, retail growth, cost control. Given this mix of factors, what's the consensus target price range looking like? And you mentioned earlier the range seems quite wide. Why is that?
Yeah, the range is notably wide. It seems to span from shorter-term estimates, maybe around 14.30 baht to 14.50 per share.
Okay.
All the way up to more long-term targets reaching 17.000 baht, 17.90 baht, and even 18.00 baht.
Wow, from 14 something to 18, that's a big difference.
It is. And this variance really reflects the differing weight that analysts are placing on the future trajectory, on that transition story we've been talking about.
How so? Well, analysts giving those lower targets, say in the 14s or low 15s, are likely factoring in a higher risk discount related to future oil price volatility or potential policy changes. They're essentially still treating OCO-R heavily as a fuel retailer, subject to those traditional risks.
Okay.
Whereas those with targets up above 17.00 baht are probably giving a significant premium valuation to the non-oil segment. They likely believe that the digital ecosystem, the EV network expansion, and the overall lifestyle diversification will successfully decouple profitability from energy risks in the relatively near future.
Right, so it's basically a bet on how quickly that transition happens. Oil retailer risk versus lifestyle premium. That distinction really helps understand the price variance. Now, let's provide some technical context for investors maybe looking at entry or exit points. Where did the stock trade recently, and what are the key technical levels traders might be watching? Okay, technically speaking, the stock has shown some positive momentum recently, which reflects both the anticipation and then the announcement of those strong Q3 results. It actually hit a 4-month high of 14.40 baht back in September 2025. So that confirms the positive trend leading up to the results.
Okay, a recent high at 14.40. For short to medium-term traders then, what are the key support and resistance levels that brokers are suggesting now? Where are the lines in the sand?
Technical analysts are suggesting that a pretty firm psychological and maybe fundamental support level sits around 13.6 baht.
13.6 support.
Yeah, that level is seen as quite crucial. If the price were to break convincingly below it, that could signal a reversal of the recent rally. On the upside, the immediate resistance cluster seems to be in that 14.2 to 14.5 baht range, which corresponds closely to that recent 4-month high we just mentioned.
Okay, resistance around 14.2 to 14.5.
Correct. If the stock can break convincingly above 14.5 baht and, importantly, sustain a price above that level, the momentum would likely carry it towards the next major target resistance level, which is projected up at 15.0 bat. So those levels, 13.6 on the downside, 14.5, and then 15.0 on the upside, kind of define the current trading boundaries based on recent market action.
Very clear. Finally, we need to cover shareholder returns directly. Did the company confirm any dividend payment related to this strong mid-year performance?
Yes, they did. Demonstrating confidence in their cash flow generation, OR announced an interim dividend payout based on the first half's performance.
Okay, how much?
The interim dividend was set at a solid 0.30 bat per share. Provides a decent return for investors holding through the middle of the year, and just for planning purposes, the ex-dividend date for that payment was set back on September 4th, 25568. So you needed to hold the stock before that date to qualify for that specific payout. #tagoutro.
Okay, that concludes our pretty intensive deep dive into OR's Q3 2025 performance and outlook. I think the main narrative that emerges is one of, well, robust profit recovery, right? Powered largely by that structural normalization of the gross profit margin in the mobility segment. A very welcome policy relief, really, and underpinned by the reliable, record-breaking volume growth from the non-oil star Cafe Amazon.
Yeah, and it seems the company isn't just, reacting to market conditions. They appear to be aggressively pursuing this identity as a lifestyle business leader.
Yeah.
We've seen concrete strategic action in the digital realm, that massive AI's partnership, the ambitious Intelligent Station Initiative.
Trying to get people to stay longer.
Exactly. All designed to turn that quick fuel stop into potentially a high-margin retail destination. Plus, those crucial investments in future energy like SAF for aviation and the rapidly expanding EV charging infrastructure, they really show a clear commitment to trying to secure their revenue stream for the next decade, whatever it looks like.
Right.
And the market sentiment, reflected in the technical indicators and the analyst consensus, suggests this strategy is at least gaining some traction.
Okay, so it feels like the short-term volatility concerns, especially around the oil margins, have been largely mitigated for now by that policy stabilization and some impressive margin control. But if we look further out towards the horizon, the core investment thesis still seems to hinge on the speed of that transition, doesn't it?
Absolutely. And this raises, I think, an important final question for you, the investor, to really consider. Despite the clear, record-setting growth we see in the non-oil segment, that whole lifestyle ecosystem, the oil business's profitability, which, let's face it, still provides the foundation of their earnings right now.
Still the biggest piece.
Still the biggest piece. It remains heavily influenced by those external factors we talked about specifically, the status of the domestic oil fund and those fluctuating global energy prices. If the oil fund, for whatever reason, were forced to cap margins again next year, that profitability could potentially be instantly reversed, or at least significantly hit.
Right.
Therefore, the real question is, how quickly must that non-oil portfolio grow, not just in volume, but in terms of its percentage contribution to total profit, to truly decouple OR's overall valuation and earnings from these perennial energy sector constraints? How quickly can it make OR a genuine lifestyle stock that's truly insulated from the energy market roller coaster? That metric, that speed of transition and profit contribution, likely defines OR's long-term success story.
A great final thought. How was our in-depth look at OR? We certainly hope this information helps you decide whether this lifestyle energy stock might be right for your portfolio. If you have any questions, or perhaps you'd like us to analyze a specific stock in a future deep dive, please do let us know. Finally, don't forget to like, share, and subscribe. It really helps support our team. Thank you for listening.